So I'm going to show you today how to save 20 years off your current home loan. Come on, check this video out. Hey, Marcus here again, and I'm going to show you today how to save time and money. So did you know if you purchase your home for $250,000 and you have a typical 30-year 4.75 interest rate, so those are kind of typical for now, right? So I'm not quoting any rates or anything. That'll give you and if it's a conventional loan, it'll give you a mortgage or MI payment of about $125. All right, so all in all, your monthly mortgage payment, excluding taxes and insurance, will be around $1,390. So that's very typical, right? Now, I'm going to show you today how to cut 20 years off of your 30-year payment. So a lot of people focus solely on the interest, and I'll tell you what this is. The interest for this will be around $212,000 for the life of the loan, okay? And that's a lot of money right there. So essentially, you're almost paying double for the purchase price of this home. And if we show you how to save a lot of money and a lot of time, okay? So for one, if you're moving into a home like, standard single family home, you're going to typically be paying somewhere around $1,600 in rent. So that's going to yield you, we'll call it $200 in savings. So it's a little bit more, and we'll call it $200. And because you're now a homeowner, you're going to have the tax benefits of owning a home. And if you work with your local CPA or your tax preparer, you'll be able to yield typically anywhere from $35,000 to $4,000 on the tax. So we'll call it $4,000, right? Now, additionally, this is the key. How do you save money throughout the year to apply to the principal? So we're going to use a thumb of $10 to $11 a day. So we're going to save $10 to $11 a day and apply that. So that actually comes out to around $4,000 as well. This is the key. You start your loan January 1st, 2020, and it is scheduled for 30 years. So in 30 years, you would have yielded or paid about $212, a little bit, almost $213,000 in interest only. What these buckets here, we're going to apply these to the home loan as we go on in time. And I'll show you the strategies that it takes. For one, you'll get out of this 30-year loan, get into another vehicle that'll help you and be more advantageous to save. Each year you're going to save and you're going to apply twice a year. So the first is going to come around income tax time. So you're going to apply one payment. So this is one time. And then you're going to save up for a year. You're going to apply a second payment throughout the year. And this is going to be a one-time payment. So total $8,000 is going to go directly to your principal of this $250,000 house. So in addition, because you saved $200 per month for rent, we're going to apply $200 each month towards your rent. So this is going to be times 12. Okay, so at the end, if you do this for 2 years, you're going to be at a point in July of 2020 where your new loan balance is going to be $200,000. Just a little bit over that. Okay. So at this point in time, you've paid off about $26,000 in interest and a little bit towards the principal. So this is where the magic comes in. At this point, you've been paying principal pay down a little bit extra per month. And at this time, we're going to refinance this into a 15-year loan. So because values of the home goes up, your MI payment will drop off. So we're going to lose this $125 MI payment. However, your 15-year loan now, and we'll be conservative because when you get a 15-year loan, your interest rate typically is less because you're going to pay it down faster and you have more skin in the game. In this instance, your skin in the game is the equity that you have in the house. So the new terms is going to look like this. 15 years from this point at 4%, your MI is gone. Your new monthly payment is going to be about 14, we'll call it $14.50, just round it, okay? So the difference in payment here is about 60 bucks addition, but keep in mind there's gonna be additional $125 that's going to go towards where your MI you're paying. So this is the secret sauce. You're going to continue to add an additional $200 to your payment. So that's still going to be consistent, and you're going to continue to pay the $4,000 and the $4,000 twice a year, right? So at the new percentage, what this breaks down to is you'll have your loan paid off in the next little under 8 years. So that'll get you to the 10. So we're looking at 2030 paid. And that's the goal. So 2030 paid off. Now, total interest before it was $212,000. With the two different loans, you would have paid $61,000 in interest. So that is an absolute huge savings for you and your family. So we're talking about $150,000 in savings. Now you own a property that's a minimum of $250,000 that you have. If you purchase in any positive or appreciating area, guarantee you in 10 years this is going to go up. Now you have leverage where you can use your newfound wealth and apply it to something else. So this is just a great strategy. Now, an additional strategy, you may say, well, maybe I don't want to increase my payment. Maybe I want to decrease it and have some flexibility. So the beauty about interest rates and amortization is it's almost like magic. So in this instance, you can actually keep the same interest rate, and you can keep refinance into a 30-year. So you did 2 years, so refinance into a 30-year. And what that'll do is, and pay the same payments that you were paying. And if you do the math, it comes out to the same exact number. So that's the beauty of the math. All in all, there's a ton of different strategies. If you have great credit and you have access to credit lines, you can do velocity, where you can actually have your whole 30-year mortgage paid off within 5 years. So, but if you do want more information about how you can save years and shave off dollars on your mortgage, please feel free, comment, subscribe, like, or share, and I'll get back in touch with you. Thank you all. Again, this is Marcus. Have a great day.